right, get this. Each U.S. household is carrying about, like, $260,000 the national debt.
Wow.
Crazy, right? And if you look at it per child, it's even more insane.
Yeah.
$484,000. We're talking about a $35 trillion hole. And just the interest payments are costing us over $1 trillion a year.
Yeah, it's a lot.
To put it in perspective, that's more than the entire GDP of a lot of countries.
Right.
So today, we are really diving deep into the U.S. debt crisis.
Right.
How we got here, what it means for our future, and where we might be headed.
Sounds good.
So this debt, it's been growing for decades, right?
It has. It's kind of like we've got this like giant national credit card and we just keep swiping it.
Oh, okay.
You know, without paying it off.
Yeah.
And all these major things like the wars in Iraq and Afghanistan, the 2008 financial crisis, the tax cuts over the years, even those COVID recovery efforts.
Yeah.
It all just added to this mountain of debt.
So it's not just the total amount, though.
Right.
It's how that debt compares to what the U.S. is actually producing.
Exactly. So there's this thing called the debt to GDP ratio. Basically, it compares what we owe to what we make in a year.
Okay.
Right now, that ratio is sitting at 120%. That means we owe more than we even produce.
Wow.
And we're talking about levels not seen since World War II.
So we're in deep. But can the U.S. actually default? I mean, what happens if we just can't pay our bills?
Okay, so technically, the U.S. can't default in the way we usually think about it because, you know, we have the ability to just print more money.
Oh, right.
But as the economist Paul Krugman pointed out, inflating our getaway is just another way to default, and that has its own set of consequences.
So we might avoid a technical default, but we'll end up paying the price in other ways.
It's very possible.
So what are some of the biggest concerns then with this ever-growing debt?
Well, one big one is the impact of these rising interest rates, you know, with inflation. The Federal Reserve, they have to hike rates, and that makes servicing our debt even more expensive.
Right, because of those trillion-dollar interest payments we talked about.
Exactly. It's like we're stuck on this financial treadmill, right?
Yeah.
We're just trying to stay in place, but the speed keeps going up and up.
Yeah. So what does this mean for everyday things, you know, like schools and roads and healthcare?
Well, those rising interest payments, they basically crowd out other essential spending.
That's
You know, it's like trying to fill a leaky bucket. We keep putting money in, but it just drains away,
Okay.
leaving less for those really important services that we all need.
So to really understand this whole thing, we need to talk about the bond market, right?
Yes, you do.
So I know it's this massive financial system, but how does it all connect to this?
So think of U.S. government bonds, kind of like IOUs.
IOU, okay.
They're seen as really safe investments.
Right.
And the bond market, which is actually larger than the stock market, it's a really important part of the global economy.
So basically, people and institutions all over the world are lending the U.S. money through these bonds.
Yep.
Expecting to get paid back, obviously, with interest. But what if they start to doubt that the U.S. will actually pay up?
Yeah, that's when things could get a little scary. If investors lose confidence, they start selling those bonds. Prices go down.
Yeah.
And those yields, those interest rates, they go way up.
It's like a domino effect.
Exactly. And that potential loss of confidence leads us to two very different scenarios for the future.
Okay.
So let's fast forward 10 years.
Okay, 10 years in the future.
And imagine the U.S. can no longer make its interest payments.
So that would be like a default.
Yes, effectively a default.
Okay, we're 10 years down the line and things are not looking good.
Right.
What are the possible outcomes for there?
So there are two main possibilities, both with big consequences.
Okay.
In one, investors still have some confidence in the U.S. even after a default.
Right.
And in the other, America totally loses its appeal as a financial powerhouse.
Okay, so two very different paths. Let's unpack them. First, the somewhat optimistic one, where the U.S. is still seen as a decent place to invest, even with a default. What would that look like?
Okay, well, even with a default, U.S. assets could be seen as relatively safe,
Okay.
especially if the world still believes in American innovation.
So kind of a flight to safety.
Yeah, you could call it that. It's called safe haven flows, where investors flock to the U.S.
Even though things are kind of a mess.
Yeah, because it's seen as the best of a bad bunch. And in response to the crisis, the government might step in with some serious fiscal stimulus.
To try and prop things up.
Exactly, to try and get the economy going again. Now, this would weaken the dollar, but there might be an upside to that.
Wait, a weaker dollar? How could that be a good thing?
Okay, so a significantly weaker dollar makes U.S. exports more competitive. American-made goods become cheaper for other countries. That boosts demand and could lead to economic growth.
So it's like a sale on American products.
You could think of it that way.
Interesting. So some parts of the economy could actually benefit.
That's right. And, with those higher interest rates, domestic investors might move away from riskier assets and put their money back into U.S. government bonds.
Okay.
Especially if they believe in the American government's stability, even after a default.
So even in this scenario where the U.S. is defaulted, there's a chance we could pull through, though probably with some bumps along the way.
Yeah, definitely a possibility. And remember, after World War II, the U.S. had a similar debt-to-GDP ratio, and we went on to have a huge economic boom.
Right.
The dollar weakened, but living standards went up.
Wow.
Industry thrived. Economic output was strong. Now, it's not a perfect comparison to today,
Sure.
but it shows that recovery is possible even from a tough starting point.
Okay, that's a glimmer of hope, but let's be real.
Right.
Things could go the other way, too. What happens if investors completely lose faith in America?
That takes us to the America loses its luster scenario.
Right.
And that's a lot more worrying. A default could trigger a total crisis of confidence in the U.S. economy. Investors would abandon U.S. government bonds, driving those prices down even further.
So like the American dream, turning into the American nightmare.
Yeah.
Our reputation is gone.
You could say that, yeah. And even though interest rates would skyrocket, there might not be enough buyers for our bonds, even with those high potential returns.
Oof, like what happened in Argentina.
Exactly. A total financial meltdown.
Not good. What else would go wrong in this scenario?
Well, those sky-high interest rates. They would hurt businesses and consumers.
Yeah.
Borrowing would become so expensive it would stifle spending, and investment would dry up.
Right.
That would probably lead to even slower economic growth, less tax revenue for the government, and we'd be stuck in a downward spiral.
Like a domino effect, the whole system collapses.
Precisely. And the consequences. They wouldn't be limited to the U.S.
Right.
A U.S. debt default, that could cause chaos in global markets. Disrupt trade, financial systems, and economies worldwide. Remember that credit card we talked about?
Yeah, the national credit card.
This would be like maxing out that card and then having it declined everywhere.
Okay, so we've got a global meltdown. What happens next?
Well, the Federal Reserve, in a desperate attempt to regain control, they might overreact.
Uh-oh.
They could try to force those bond yields down by printing a ton of money.
But didn't we say printing money is risky?
It is, especially on a huge scale. The goal would be to stop those bond prices from completely crashing and try to stimulate the economy with lower interest rates.
Heck.
But printing that much money, it would almost certainly lead to runaway inflation, and that would just further damage confidence in the U.S. dollar and the whole economy.
It's a gamble.
It is. Ultimately, the outcome of this scenario really depends on one thing: confidence in American innovation. Will investors still believe that America can adapt? That we can innovate and pull ourselves out of this mess?
Or will they just give up on us entirely?
That's the question.
That is a big question. And unfortunately, we don't have a crystal ball.
We don't. But, understanding these different scenarios, it helps us grasp how serious this situation is.
Right.
And how urgently we need solutions.
And speaking of solutions, that's where we'll pick up in the next part of our deep dive. We'll explore who actually owns all this debt, delve into those potential global ripple effects, and see what steps the U.S. could take to, avoid complete disaster.
Welcome back. So before we jump into solutions for this U.S. debt crisis, let's take a closer look at who actually owns all this debt.
Right, because it's not like there's this one, giant lender out there.
No, not at all.
So who are the big players holding all these U.S. IOUs?
It's actually a pretty diverse group. You've got foreign countries like Japan, China, the UK.
Right.
Then you've got institutions like central banks, commercial banks, wealth funds.
Okay.
And get this, even the U.S. government itself owns a chunk of its own debt.
Wait, how does that even work?
I know, it's kind of mind-boggling. But basically, different government agencies like the Social Security Trust Fund,
Right.
they hold U.S. Treasury securities. So it's like the government borrowing from itself.
So if the U.S. defaults,
Yeah.
it's not just these foreign countries or big banks that would get hurt, but regular Americans too.
Exactly. And things like Social Security.
Wow.
And that brings us to those global ripple effects we touched on earlier.
Right.
A U.S. default. That wouldn't stay within our borders. It would be a shockwave felt through the whole global financial system.
Right.
Imagine like a giant Jenga tower.
Whoa.
You pull out the wrong block,
Yeah.
the whole thing comes crashing down.
So paint a picture for me. What would those global repercussions actually look like?
Well, a U.S. bond crash, that would probably trigger a global panic in financial markets.
Makes sense.
Investors would likely pull out of all sorts of risky assets and look for safer havens.
Oh,
You'd see wild swings in currency values, commodity prices, stock markets.
so basically chaos.
Yeah, a lot of uncertainty. But the impact goes beyond just those market swings. Remember how we talked about rising U.S. interest rates affecting other countries?
Yeah.
A default would make that way worse.
Huh.
As U.S. rates go through the roof, other countries would have to raise their own rates to compete,
No.
to stop all the money from fleeing their economies.
Right.
This creates a domino effect, making borrowing more expensive everywhere for businesses, for individuals, and in the end, it could even lead to a global recession.
Okay, so the stakes are super high, not just for the U.S., but for the entire world. So what can be done? What are our options to, actually avoid this potential financial disaster?
That's the million-dollar question, and unfortunately, there's no easy answer. We basically have 4 paths out of this debt crisis.
Okay, lay them out for me.
All right. So we could have an economic boom, we could print more money, we could raise taxes, or we could cut spending.
Okay, let's start with the fun one. The economic boom.
Mm-hmm.
Can we just grow our way out of this?
Well, it's possible, but it's risky because we're relying on factors outside our control.
Right.
Remember how the U.S. had that big boom after World War II?
Yeah.
The economic landscape is very different today.
Okay, so counting on a miracle might not be the best strategy. What about printing money? Could that work?
Technically, yes, the government could just print a ton of money to pay off the debt,
Okay.
but that would almost definitely trigger hyperinflation.
Right.
Prices would skyrocket, the dollar would plummet. It would just decimate everyone's purchasing power,
Yeah, not good.
leading to massive economic instability and hardship.
So printing money is probably not the way to go. What about raising taxes? Could that be the answer?
Well, raising taxes could bring in more money for the government,
Right.
but it's politically unpopular, and it could actually hurt the economy if it's already struggling. Imagine asking people to pay more taxes when they're already facing rising costs.
Yeah, that wouldn't go over well.
It could backfire and make economic growth even slower.
So it seems like we're left with cutting spending. Is that the most realistic option?
It probably is the most feasible, but it requires a lot of political will
Right.
and a willingness to make tough choices. The focus needs to be on cutting wasteful spending and those government inefficiencies,
Oh, yeah.
not just slashing essential services.
I'm sure there are plenty of places to cut the fat in the government. What kind of wasteful spending are we talking about?
Studies show that the U.S. government wastes, get this, anywhere from $250 billion to almost $1 trillion every year.
Wow.
That's insane. We're talking about things like programs that duplicate each other, systems that are outdated, just bureaucratic nonsense, even simple payment errors.
It's crazy how much money just disappears.
It is. Imagine what we could do if we use those funds productively.
Yeah, it seems like if the government could just plug those leaks, they could make a real dent in this debt problem.
Absolutely. But to achieve that, we need a big change in mindset, a commitment to responsible spending, and frankly, the political courage to make those tough decisions. It's a tall order, but it might be our best shot at getting through this crisis.
So cutting spending seems like the most sensible path, but it definitely has its own hurdles. Are there any other ideas out there, even unconventional ones?
Well, there's this idea that's been floating around, but it's more of a thought experiment than an actual solution. It's called the $1 trillion coin.
The $1 trillion coin. What is that, like some magic trick?
Basically, the idea is that the U.S. Treasury could mint this platinum coin with a face value of $1 trillion.
Right.
They'd deposit it at the Federal Reserve and use that money to pay off some of the debt.
Hold on. So we could just, create $1 trillion out of thin air. Wouldn't that cause crazy inflation?
It very likely would, and honestly, it's doubtful that global markets would even take it seriously. It's more of a fun what-if scenario.
So back to the drawing board then. Are we doomed? Is there any reason to be optimistic here?
Look, the situation is serious, but I don't think it's hopeless. The U.S. has survived financial storms before,
Right.
and the dollar's position in the global economy gives us some resilience. But the size of this debt and the lack of easy solutions, it makes this really challenging. It's like sailing in uncharted waters. We don't know what's ahead.
So the future is uncertain, but we need to act now.
Absolutely.
The longer we wait, the harder it gets.
Yeah.
But what can we as individuals even do? It feels so overwhelming.
That's a great question, and one we'll get into in the final part of our deep dive.
Okay.
We'll talk about what steps individuals and society as a whole can take to build a more sustainable financial future. Because ultimately, this isn't just about numbers.
Right.
It's about the future we're building for ourselves and for generations to come.
Welcome back to our deep dive on this U.S. debt crisis.
Yeah.
So we've explored the causes, the potential consequences, and those, limited options for dealing with it. But now I'm wondering, what can we as individuals actually do,
Right.
In the face of this massive problem?
It's easy to feel kind of helpless when you're looking at something this big.
Yeah.
But even small actions, when millions of people are doing them, they can add up and make a real difference.
Okay.
And it all starts with understanding the issue, becoming informed citizens, and, taking action in our own lives.
So knowledge is power. What are some things we can actually do, to become more financially savvy?
Well, first of all, just stay informed.
Right.
Read articles, listen to podcasts, like this one.
Of course.
And have those conversations about it. The more we understand this debt crisis, the better we can make informed decisions.
Right. And actually advocate for change.
Exactly. We got to go beyond just passively taking in information.
So how do we make our voices heard? How do we advocate for change?
One way is to engage with our elected officials.
Okay.
Write to your congresspeople. Go to those town hall meetings.
Right.
Let them know that you're paying attention to what they're doing and that you want them to prioritize responsible spending to address that wasteful spending we talked about.
So holding our leaders accountable. But what about our own personal choices? I mean, can those really make a difference when we're talking about something this big?
They absolutely can. Even though those individual actions might seem small, they contribute to a stronger, more resilient economy overall.
Okay.
So take a look at your own financial habits. Are you budgeting well? Saving responsibly? Are you avoiding taking on unnecessary debt? When millions of people make those choices, it creates a ripple effect.
Okay.
Promotes financial well-being, across the board.
So it's like recognizing that we're all part of a larger system.
Exactly.
And our individual choices have an impact.
Right. Are there other ways we can, align our actions with our values and help build a better future?
Yeah, I'm curious about that.
Well, one powerful way is to support businesses and organizations that are doing things the right way, the ethical way. So think about shopping locally, supporting companies that have strong environmental and social records,
Okay.
investing in companies that align with your values. By being conscious about where we spend our money, we can help shift the economy in a more sustainable and equitable direction.
So it's like taking action on multiple levels.
Yeah.
Educating ourselves, engaging with our elected officials, making those responsible financial choices, and supporting the right business.
It all ties together.
It's about understanding that we're all connected.
We are.
And our choices matter.
They really do.
This whole conversation has been, a bit sobering, but ultimately, I feel like it's been empowering.
I agree.
We're facing a big challenge, but I also feel hopeful that we can get through this together.
Definitely. This isn't a time for despair. It's a time for action.
Right.
Informed action. And by understanding this issue, talking about it, and making responsible choices, we can create a better future for ourselves and for the generations coming after us.
Well said. Thank you for joining us on this deep dive into the U.S. debt crisis. Hopefully you found it informative.
I hope so.
But most importantly, inspiring. And remember, we all have the power to shape the future. Let's use it wisely.